Welcome to It's the Economy. We know that Indian corporate equities have done exceptionally well in the first half. How did debt do? How did corporates do on debt metrics? Well, it appears equally brilliantly according to the rating agencies. CRISIL says 506 companies were upgraded by them in this first half and only 184 were downgraded. ICRA says their number of upgraded companies were 2.2 times the number of downgrades. That's more than double. But this is, of course, average, sectorally speaking. Within them, there are some ultra-strong sectors and some weak ones like chemicals and textiles. Both rating agencies have written in their release. To get an idea of the sectors and, more importantly, the outlook, how long will the debt metrics look so good? I have with me Mr. K. Ravichandran, Chief Rating Officer at ICRA, and Somashekar Beburi, the Chief Criteria Officer and Senior Director, Regulatory Affairs and Operations at CRISIL. Gentlemen, thank you very much for your time. Somashekar, if I may start with you. Excellent upgrade, downgrade. Is this the best ever ratio we have had, 506 to 184? Is it, or 2008 was perhaps the last such superb upgrade downgrade ratio?
Lata, thanks for inviting us. Yes, the number of 2.75 is amongst the higher ones that we have seen. But just after COVID, when there was a very sharp rebound in the economic demand and the cash flows were very robust and companies were just intent on deleveraging, we did see a much higher number touching even 5.5 times in the couple years back. But yes, I mean, this is amongst a number which is amongst the higher side, 2.75 that we've seen in the past.
Okay. Ravichandran, would this also rank among the best for you? How does it compare historically?
Yeah, historically we've had on annual basis more than 3 times, especially in financial year 2022. Since then, it has been moderating. We had about 2.2 times. For the off year ending September 24.
Mm-hmm. Okay, Somashekar, how are the number of downgrades doing? Are they falling or rising? If you only compare downgrades historically.
When we look at the number of downgrades, that's 184. But when I look at it as a percentage of the overall base of about 7,000 companies, that came in at about 5.3%. And yes, it is lower than our 10-year average of about 6.5%. So it is trending a little downwards, as well as if you look at another metric, which is defaults. Even there also the default rate is also trending lower, at about 0.4% annualized. So that also indicates that there is resilience and buoyancy in terms of cash flows, which is there.
Okay, let me come to sectors. Ravichandran, who did very well, and it looks like both of you have found chemicals and textiles on a weak footing. If you can explain, give me some nuances, Ravichandran.
Yeah, sure. See, in the case of chemicals, China has been the biggest, spoil sport. They have huge capacities, so more than 10 times bigger than India. So because of the slowdown in the construction sector in China, they are left with huge overcapacity, which they are flooding the market, which is resulting in higher inventory and price related, impact. It is ebbing in few cases. There are, chemicals is a really omnibus term. There are different subsegments within that. The deep impacted would be agrochemicals. Otherwise, if you look at sector which has really turned around, would be specialty chemicals. Other chemicals like petrochemicals and polymers, etc. They would fall somewhere in between in terms of impact. So most of them are somewhere in the low to mid end of the margin cycle.
Okay, that's important to note. Somashekar, both you and ICRA are pointing out that infrastructure has done very well. In fact, Ravichandran's note also points out to power, more specifically renewables, doing well. Can you tell us, infra has always been the one that was dragging the averages down. Why are they looking good, and is the outlook also good?
So coming to infra, over the last at least 4 to 5 years, what we have seen, the credit quality trends have started showing an improvement. And there are multiple reasons for that which are there. If you look at segments such as renewable power capacities, you are seeing a lot more participation of central counterparties, which is there. That is giving a lot of comfort to the stakeholders in terms of payment security, and we are seeing a lot of upgrades there. Also contributed in part by the fact that there is lower debt which is sitting compared to what we had expected in the renewables, as well as takeover by stronger sponsors, which is there. Road projects, if you look at especially the HAM road projects, as they achieve milestones and the project risk reduces, so they naturally tend to reflect the counterparty risk, which is NHA, from which the annuities start coming in. So that's also a sector which is doing well. The construction segment also is amongst the ones which has done well amongst the infrastructure linked sectors because of fairly robust order execution, and capital goods segment is benefiting as a lot of infrastructure spend. If I look at overall infrastructure itself, 38% of the rating upgrades in our portfolio of the 506 I have mentioned are either infra or infra linked in the first half.
And if infra itself, yeah.
And outlook also, when we looked at 12 different sub-segments of infrastructure sector, we have a fairly positive outlook on almost all of them. So outlook also is fairly positive.
Okay, that's good to hear. Even Ravichandran points out in his release that many projects have transitioned from project stage to operational stage, and that has accounted for healthy infra balance sheets. Ravichandran, what's your sense about financials? The anecdotal news, RBI going after gold companies, unsecured debt, microfinance. Is financial sector as good as it was last first half?
Yeah, financial sector overall, still they are in a healthy position, I would think. But within that, there are certain segments are showing signs of incipient stress. The companies which are dealing with unsecured loans, personal loans, business loans, and MFI loans of late, they are seeing strains in few states, I would think. Largely on account of unabated, lending by the industry. The growth was upwards of 25-30%. Because of that, and also the multiple leveraging by the borrowers, it was a heavy combination, resulting in stress in few pockets. But within MFI, there are large MFIs who are not affected that deeply as compared to smaller MFIs. I would think they are well capitalized and they should be able to ride out this storm, especially after the industry level guardrails which have been put forth by MFIN.
Okay, that's good to hear. Guardrails have come in, but it's important that the debt is showing some strain. Somashekar, one of the best paragraphs in your release is the outlook. Just tell us, how does the debt quality look that it will sustain in all of FY25, FY26?
Yeah, so when we look at the outlook both on the corporate side, infrastructure side, as well as even when we look at the financial sector side, I think the credit quality outlook is fairly positive. Government continues its infrastructure investment. The private consumption is something which is reviving. Also, we are anticipating rate cuts which will start happening, and that should spur a bit of domestic demand as inflationary pressures are likely to kind of subside. So what we will, on the other hand, be watchful of is the heightened geopolitical risks, which could create some bit of a challenges, if at all, on our export-oriented sectors and disrupt supply chain. So that's something that we are a little bit cautious about. And like I think what Ravichandran mentioned, in the financial sector specifically, unsecured loans and microfinance are pockets where asset quality numbers could show a little bit of increase in terms of delinquencies, and that's something which we'll be watchful about.
Okay. Two last quick questions to both of you. Ravichandran, has capex picked up? And usually debt starts looking difficult when capex really takes off. Are we anywhere in that inflection point?
See, capex, one has to look at capex by listed companies and unlisted companies. When it comes to listed companies, certainly there has been a good pickup, especially in the green areas of the market, pump storage and renewable energy, EVs and so on and so forth. Plus other capital intensive sectors like oil and gas, telecom, metals All of them are, in midst of brownfield projects and the greenfield projects, etc. So on a year-on-year basis, I would think, the capex has been growing by more than, 10-12%. When it comes to unlisted companies, that's a very large pocket, also contributing to capex in terms of overall gross fixed asset formation. There, I mean, the kind of growth has not been that, good, I would think.
Okay. What about you, Somsekhar, quickly on capex?
So very clearly, we've done an interesting analysis on 900 companies in our portfolio, and we are seeing that fiscal 24 and 25, the aggregate annual average capex is about 4.3 lakh crore compared to 3.2 lakh crore just prior to the onset of COVID, 2019 and 2020. Other thing which we looked at is we look at capex intensity, which we are measuring by capex to EBITDA. That is at around about 50% currently, compared to even a decadal high of 72%. So we would say that the capex intensity is not that high. In terms of sectors, yes, steel, cement, oil and gas, exploration and refineries, also PLI-linked sectors, including pharma and some electronics, auto components. Those are the sectors which are seeing a lot of capex in the manufacturing sector.
Okay, just 10 seconds left, but Ravichandran, you're most bullish on the hospitality sector. No downgrades for the past 2 years.
Yeah, that is, certainly reflected in the high room tariff and occupancy, over the years. Well, there has been minor slowdown, I must confess, in the current financial year because of elections and heat wave, etc. But then, if you look at the anticipated supply additions, according to our estimate, that will lag demand growth rate, especially in metros. Rates are going to be very firm, at least for another 2 years. That's a good sign for some of the large hotel chains, according to us.
Okay, on that optimistic note, let me wrap up this discussion. Thank you very much, Somsekhar and Ravichandran, for laying out the debt performance of the first half. It's been excellent. That's the verdict coming from the two rating giants. But of course, there are some chinks in the armor. Textiles and chemicals haven't done too well, and hospitality, of course, gets a huge thumbs up. Most importantly, infrastructure is doing very well. That's really the benchmark of debt performance. Thank you very much for joining us on this special edition of Bazaar. After a break, chat on.